Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Good evening to all our online viewers and audience. Today is Monday, December 15th. I'm glad to be here on the first trading day of the week to share 2 topics with you. The first one is, next week is Christmas. Traditionally, there tends to be a market movement around Christmas time. Well, usually if we look at this period in the past, it's generally more positive. So let's first take a look at what kind of mindset we should have for this week. As we've listed in the title here, we still need to be both optimistic and cautious. Alright, why is that? I'll explain in a bit. Also, if we're looking at what might drive the market this week, are there any possible positive or negative factors? We'll go through them one by one and share the latest information with everyone. Okay, I see we have viewers online. Alice Fu, hello, good evening to you. And Anna Ya, hello as well. Now, let's get into today's main topic. Actually, before we talk about the Christmas market trend, let's go back to 3 years ago, when ChatGPT first came out. That was when the AI field started to really heat up. And even now, it's still going strong, like the recent buzz around Google's Gemini. Everyone finds artificial intelligence to be performing really well and very useful, whether it's generating images, chatting and interacting, providing the latest information, or even using it as a personal advisor. People are making good use of it. There's no problem at all. Its performance is excellent. Now, the main point of debate among investors is whether, as we hear rumors in the market about a potential AI bubble, we should pull back before this bubble bursts, like stopping just before going over a cliff. Or should we keep increasing our investment? With capital like this, should we continue to put it into these disruptive technologies, like artificial intelligence, which still have new applications and potentially even more business opportunities down the line? Should we seize these chances? This is currently the main point of debate among the market and investors. Here's where it gets interesting. It brings up a strange question. If everyone knows it's a bubble, then everyone would want to sell at the very top, right before the bubble bursts, right? But the problem is, no one actually knows when the bubble will burst, and it's not even certain that this is a bubble at all. Well, if everyone were really that smart, then of course, maybe there wouldn't be any mail carriers on the street, or people selling lunchboxes, or stationary vendors. None of that. Because if everyone knew exactly when the bubble would burst, then everyone could sell at the very top. If everyone sells at the very top, would that point still be the top? Well, not necessarily, because someone would have already sold before that, right? Maybe it would have already started to drop. Okay, let's take another look. As for the S&P 500, over these past 3 years, referring to the recent intense development of artificial intelligence, the market cap has increased by $3 trillion. And this upward trend, it's mainly been driven by a few major tech giants like Alphabet or Microsoft, Google and Microsoft, for example. Even chip manufacturers like Nvidia and Broadcom, companies that benefit from the AI infrastructure, have played a role. And what else? Artificial intelligence needs computing power, which requires a huge amount of electricity, so companies involved in power supply are also part of this trend. If they stop rising, what about the stocks? They might fall as a result. He actually said something here that I really agree with. He said that stocks don't pull back just because the growth rate declines, but rather when the growth rate stops accelerating. In other words, the market always hopes for optimism. It wants to see growth rates not just high, but higher and higher, accelerating more and more. Some of these tech giant CEOs might make such statements, or at least express this kind of optimistic confidence. Maybe they really do see strong demand in the industry, but in reality, we'll only know in hindsight whether the growth rate is actually accelerating like that. So as he said, if the growth rate stops accelerating, these stocks will pull back. But is that really true? Let's first take a look at what happened last Friday. The S&P 500 actually was quite strong. But after reaching a high, it pulled back because it hit a new high first and then dropped. On Thursday, the day before, it set a new high, but the decline wasn't that deep, just about 1.07%. Next, let's look at the Nasdaq, which dropped a bit more. It fell down to this level. It touched the 20-day and 50-day moving averages. Its decline last Friday was 1.91%. Of course, there's still some distance from the blue line, the 100-day moving average on our chart. There's still a bit of a gap to the 100-day moving average. Why do we specifically mention the 100-day moving average? Because it just so happens that last time, as we can see in mid to late November, at that time, after it dropped, it then rebounded and went up again. That area, that zone, was right around the 100-day moving average, so that's what the chart shows. The same goes for the Dow Jones, and as for the Dow, that's even more obvious. Relatively speaking, among the three major indices, it might actually be the strongest one. Also, besides the fact that it still clearly shows a textbook example of a bullish alignment, on Thursday it had a very strong surge, with both price and volume rising together, reaching a new all-time high. Of course, the next day, on Friday, there was some volatility, and the drop was actually less than 1%, only about 0.51%, so it really wasn't that serious. Plus, we can also see that for these large, traditional blue-chip stocks, a drop like this at most can only be considered a period of consolidation. Let's look at some optimistic reasons. As we mentioned before, the Federal Reserve had already, as expected, cut interest rates for the third time by 25 basis points. That is, a quarter-point cut each time. They are optimistic about the outlook for economic growth and believe that tariffs, the impact on inflation is temporary, meaning they don't believe that tariffs will have a lasting long-term effect on inflation and prices. Alright, so that's one point. The second point is that starting from December 12th, which was last Friday, they will purchase $40 billion in treasury bills every month to boost the financial system's reserves. This move can help. The liquidity in the overnight funding market is getting better and better. In other words, they hope that this liquidity doesn't dry up. Of course, whether it's in the stock market or the bond market, as long as there's sufficient liquidity and plenty of capital. Usually, even if there is a short-term pullback, as long as people don't feel that funds are too scarce, then basically the market will still gradually return to its proper track, according to the state of the economy or corporate profits. Alright, now let's take a look at the head of central bank strategy at Apple Corp. He said that the December rate cut was moderately hawkish, but what about his views on growth rate and productivity growth, especially since these views are very friendly toward risk assets? For example, when it comes to risk assets, let's take this as an example. Stocks in the stock market are one type of risk asset. Next, let's look at the second point, the Fed official dot plot. The median forecast suggests that next year, that is in 2026, there will be one rate cut. However, the market doesn't necessarily see it that way. Alright, many traders in the market are still estimating that there could be 2 rate cuts in 2026. Now, let's take a look. There are ongoing discussions, whether it's questioning or criticizing the Fed. As for former US President Trump, what did he say? Well, as usual, he stuck to his usual line, saying that the Fed's rate cuts are too small. As everyone knows, he actually wants interest rates to go down further, and he thinks the cuts should be bigger. He also said that he plans to meet with Kevin Warsh and have a face-to-face conversation with him regarding whether he will take over as Fed chair in May of next year, in May 2026. Of course, right now, both Hazard and Warsh are considered two of the leading candidates. Some say that Warsh might even be one of the top contenders. But actually, I think given Trump's personality, he might be more. Unpredictable and changeable, so we still have to wait for the official announcement, or even after the appointment, before everyone will have a clearer idea of the outcome. So looking at it this way, of course, when he actually becomes the chairman of the Federal Reserve, his mindset might change. Once he's in that position, his thinking could shift. While he's still a candidate, he might be very close to Trump, and their ideas could be perfectly aligned, just like two peas in a pod. But after he takes office, what else might he face? As for the chairman of the Federal Reserve, when he faces his colleagues, like the other board members, or even has to attend occasions such as hearings, he might not be entirely. What I mean by not entirely is that maybe Trump will have some influence over him. But he won't necessarily follow Trump's wishes to the letter, and that's something everyone should pay attention to. Okay, so next, let's look at why we need to be cautious. First of all, let's look at Ed Yardeni, a senior figure on Wall Street. He's actually been working in this field for a long time, so his opinions are generally worth referencing. He suggests, compared to the other S&P 500 component stocks, that now is the time to underweight technology stocks. In other words, the proportion of tech stocks people hold has been at different levels in the past. So some people hold 70% in stocks, some hold 90%, some only half, and some just 10% or 20%, or even none at all. It's all different. So when we talk about underweighting, it means that if you previously had a significant portion in the Magnificent Seven, you might consider trimming your position a bit. Or if someone hasn't entered the market much yet, then maybe it's not necessarily their top choice. Maybe that's just their perspective. And what are their reasons for that? He said that he's seen more competitors flooding into the areas where the Magnificent Seven are making huge profits. In other words, competing directly with them. What do the Magnificent Seven do? They're in e-commerce, search engines, and tech products like smartphones, iPads, and laptops. Alright, all of these are included. He said that in reality, every company is trying to transform itself into a tech company. In other words, there are more and more potential competitors. So aside from the established, powerful companies already in the game, there are also a lot of startups. Of course, whether they can actually take on the Big Seven is another matter, because what sets the Big Seven apart is that they have three major advantages: more technology, more talent, and more capital, right? So even if he sees a new company, he can still, when he sees something with potential, he can just buy it up first. A very famous example is Meta, which is the parent company of Facebook. When they saw Instagram and thought, hey, this has a lot of potential, they just bought it outright and made it part of Meta, turning it into one of their subsidiaries, or a company they hold a controlling stake in. So whether these small or new companies can really grow into giants still needs to stand the test of time. Alright, now why do we need to be cautious? Although, as we just mentioned, at the third meeting, as expected, there was a rate cut of 0.25%. There were also dissenting voices. Specifically, 3 people expressed their disagreement. Of course, one of them, as we know, is Neil Kashkari. He actually advocated for a more aggressive rate cut. Let's set that aside for now. As for the other 2, they actually preferred not to cut rates this time. In other words, they wanted to keep the interest rate unchanged. So at this point, we can see that what appeared in their statement: the magnitude and timing of interest rate adjustments. In other words, both the scale and the timing. This kind of statement hasn't appeared since July, but this time it was brought back into the statement. That means whether it's about how much to cut rates or when to make the adjustment, perhaps in every meeting going forward, these issues will be considered. There will be new kinds of conclusions and new kinds of outcomes each time, meaning he hopes the market will stop making assumptions about the policy path. Of course, the Fed chair is definitely going to say this, because he won't tell everyone, next time we're going to do this, or next time we're going to hold steady. He won't say that. He has to maintain his, let's say, unpredictability, or at least not be too predictable. Second, it gives him some ambiguity so that each time he can make decisions based on the latest economic data. Alright, here I think another really important concept is brought up. Luis, with the long fingers, Luis, he mentioned that the AI bubble is shrinking, but it hasn't burst. So what does it mean for a bubble to be shrinking? Well, if you blow a bubble, it's not like either it bursts or it keeps getting bigger, right? If you keep blowing it, it just keeps getting bigger. So how does it shrink? Only when stock prices start to pull back a bit do people feel like, hey, the bubble seems to be contracting a little, meaning the hype is cooling down. It's not as intense anymore. Not that kind of non-stop euphoric blowing up of the bubble. People are saying that the AI bubble is indeed shrinking, but it hasn't burst yet. It hasn't. If it were like the dot-com crash, then a lot of companies, having surged during the boom, would, when things get crazy, see their stock prices slashed in half. Or some companies would go bankrupt, shut down, and liquidate. Some would be so deep in debt that there's nothing they can do, and they'd have to exit the market altogether. But right now, we're not seeing that kind of situation. In fact, even more startups are jumping into this AI boom. Alright, let's take a look at the bubble. We'll look at market capitalization and ratios. Again, we're focusing on the so-called $1 trillion club. First, we see Nvidia, Apple, Google, Amazon, Broadcom, Meta, Tesla, and Berkshire. Looking at the highest ones, their price-to-earnings ratios are, for example, Nvidia's is around 44 times. Apple is at 37 times, Google at 35 times, Microsoft at 33 times. Amazon is a bit special. There are 2 outliers. Broadcom is about 73 times, and Tesla is at 330 times. These are quite different from the usual range of around 20-something to 40-something times. Alright, so here we're looking at the price-to-revenue ratio. This can serve as a reference for everyone. Generally, most companies fall within a certain range. Broadcom is an exception because it has a lot of traditional industries. Usually the ratio is around 8 to 10 times, or in the 20s, which is actually pretty reasonable, since these companies are the mainstream players in the market right now. There are reasons why the prices are high. It's because there really is buying support behind them. These prices also reflect the level of confidence global investors have in them. Alright, next, let's take a look at the two companies we mentioned earlier that are a bit more unique and see how they're doing. So when you look at Tesla, you might wonder, is a PE ratio of 330 really that high? If it is, then why was it able to start rising again from, say, September after a pullback in November and keep going up? So it's not entirely absolute. Oh, and as I mentioned earlier, there's also that chart above. This kind of table showing market cap and ratios is something I really want everyone to pay special attention to. Please take note of the market cap, the PE ratio, and the price to sales ratio, because all of these are related to the stock price. Alright, so these numbers are only valid for today. After tomorrow, the numbers might change, so they don't stay the same for long. Please pay special attention to that. This is just for your objective reference. Okay, let's take another look. Also, as I just mentioned, there are those with a PE ratio of over 70. As for APG1.com, if you just look at the line chart, actually since the end of June, it's been pretty consistent. That is, after a significant rise, there's a slight dip, a minor correction, and then it continues to go up. In fact, before that 11.43% drop on Friday, it had even hit a new all-time high. So, does a PE ratio in the 70s really mean it's too high? Well, not necessarily, because from June up to December, hasn't its stock price performed really strongly? So the PE ratio by itself, just as a number, whether it's high or low, can't fully determine whether the current valuation is absolutely high or low. You have to look at it together with other factors. Alright, next, let's take a look at Meta. Earlier, we saw a relatively low PE ratio, in the 20s. Look, Meta's PE ratio is in the 20s, right? It seems lower than those in the 70s or 30s, so does that mean it's absolutely cheap? But after hitting a few price highs around August and September, its stock price started to pull back and correct. Alright, so as for whether it's already bottomed out, it's still hard to say, because there could still be some factors in the future. For example, whether the smart glasses they've launched can face competition from, say, some smart glasses manufacturers in Asia or China. Will they be able to withstand those challenges or face that competition? That still remains to be seen, so we can't confidently say that this is immediately a bottom. Alright, let's use a sentiment indicator to help us out. We can clearly see that in the Comprehensive Mix Index, during the months of October and November, it actually hit relatively significant high points for those specific periods, meaning the recorded numbers were considerably higher at those particular times. In November, we saw it was roughly between 26 and 28 for about a day or two. In October, it was also above 26 for about a day. So in total, there were about 3 days when it went above 26. Basically, just those 3 days. These days, there are 2 days here. Now, let's take a look and see if this was actually the low point at that time. Let's use the S&P 100 as a reference. But actually, if you notice, we just mentioned that usually when the S&P 100 drops, volatility spikes, right? But what about in October? Did everyone really feel like it dropped that much? If you look at it from this kind of line chart, actually it only lasted a few days. Honestly, just 1 or 2 days and it was over. So if you look at this recent history, when we see these kinds of drops happening lately, it went up above 26, but that only lasted for 3 days. So if you bought in during those 3 days, of course, looking back now, it seems like you bought at a pretty good point. But that might not always be the case. Sometimes if the VIX really spikes too much in the short term. When the volatility is like this, when the pressure is too strong, it's possible for it to jump continuously from the 20s all the way up to 30 or 40. But if it just breaks through 30, how long can it actually stay there? That's the real question. So if you see the VIX really spike sharply in the short term, what kind of strategy can you use? Maybe you should first observe for a bit and see whether this negative news is structural, or how long its impact might last. If it's really just some sudden, unexpected negative comments, then you might want to consider that, hey, maybe this is a good opportunity. Or to put it another way, if it really spikes to an extreme level like 50, do you think it can stay there for long? Looking back over the past 6 months, we haven't even seen it go above 30. Alright, the highest we've seen is between 28 and 30, so that's a situation over the past 6 months. Of course, this doesn't mean that just because it was like this in the past, it won't go above 31 in the future. That's hard to say, but we can look at it as an auxiliary indicator, something everyone can use. Keep an eye on it. Now, last Friday, everyone was saying, hey, it seems like the market is really heavy, right? The Hang Seng Index dropped more than 5%, didn't it? But the VIX, of course, is for the S&P. The S&P, as we just saw, only dropped 1.07%, so the VIX only went up a little, about 6% or so. Right now, it's roughly between 14 and 16. Let's take a look at this. The value is about 15.74, which actually isn't much different from before. It's still in that tight range between 14 and 16. Basically, it's in the same zone. Next, let's see where it goes from here. If it starts to rebound today, then historically, it might dip a little further. But if some selling pressure shows up again today, if the selling pressure comes back, then if it goes up a bit, getting close to 17 or 18, that's not a big deal either, right? It's nothing to be really worried about. Okay, let's take a look at what's coming up this week. What important financial events and economic data are on the horizon? First, tonight we'll have the New York State Manufacturing Index. Then starting tomorrow on the 16th, there will be more, like the non-farm employment data, which basically covers November. As for October, there will be more data coming up. The first one is a bit uncertain, and that's because during the government shutdown, some of their data, actually about half of it, might require things like field phone calls or in-person visits. So it's possible that the data for October might not be available at all. That's a real possibility. This includes the unemployment rate and even the S&P Composite PMI, as well as the manufacturing and services PMIs. And of course, around the 17th, we'll have the initial and continuing jobless claims numbers, as well as the CPI, the Consumer Price Index. So this week, indicators that the Fed pays close attention to, like employment and inflation, will all be released. Then on the 19th, we'll have the University of Michigan's Consumer Sentiment Report and the short and medium-term inflation expectations. All right, let's keep going. First, let's look at the strength and weakness of different sectors. This refers to last Friday's sector performance. The S&P 500 dropped 1.078%. Among the stronger sectors, we have metals, glass, apparel, clothing, and automobiles. On the weaker side, there are semiconductors, electronic manufacturing, and electronic components. Notably, we see that semiconductors fell by 5.35%, while electronic manufacturing dropped by 5.6%. As for electronic components, they dropped by 7.3%, which is quite a significant decline. Since we've just mentioned semiconductors, let's take a look at what factors are driving or creating noise in the market related to technology and semiconductors. Actually, we've been talking about this for quite a while now. From Google, Microsoft, Amazon, to Meta, these big companies are expected to spend hundreds of billions of dollars in capital expenditures over the next year. Most of the spending will go towards data centers, which means it's closely related to computing, data traffic, and the overall handling and presentation of data. In addition, this strategy was mentioned by Michael, who said the following. He said that whenever growth is expected to stagnate or slow down, it can cause investors to send out signals like, oh, there might be some problems here. But there's a question mark here. Does this really mean there's a problem? It used to be all about growth, so why is it like this now, right? Did something go wrong? People start to have doubts and begin selling stocks, so this is an unavoidable situation that comes up during this phase. Because when growth keeps going, everyone thinks, what if one day growth slows down? Then they start selling stocks, and the market experiences some selling pressure. Alright, since we've brought up technology and semiconductors, let's take a look at the daily situation. Last Friday, the Philadelphia Semiconductor Index dropped by 5.1%. That sounds like a lot, but actually, some individual stocks didn't fall that much. For example, Texas Instruments and Analog Devices didn't drop as much. Now, as for the ones that performed worse, which ones are they? Astera Labs, Broadcom, then Coherent, or Credo, and Micron. Wow, Micron dropped more than 6%. But are these really terrible companies? I actually don't think so. Let's take a look at another one. Now, that's just for a single day, right? What we're looking at now is from June 30th, which is the start of the second half of the year, up to December 12th, which was last Friday. So that's a little over 5 months. We can see that the situation is quite different. We see, for example, Teradyne and Photonics. In less than half a year, it went up by 115%. Coherent rose by 99.9%. And Micron increased by 95.65%. As for Intel, well, when it comes to the long term, everyone says their technology lags behind TSMC, but in reality, over the past half year, since the end of June, its growth has also been astonishing, rising by 68.79%. Applied Materials went up by 64.91%. I just saw this. Even the ones that dropped the most last Friday have actually risen over the past half year. For example, 64.62%, and KLA went up by 55.43%. AMD at 48.54% is also quite impressive. So among them, as we just saw, over the past 6 months, TSMC really hasn't performed that well. In fact, its stock price has actually been on the weaker side. Let's take another look. But what about the international stock markets and investment news? Actually, there are a lot of market forecasts, and many institutions, large asset management companies, or investment banks still hold a relatively bullish and optimistic attitude. Why? Because the market just hit a new high last Thursday, and only pulled back a bit on Friday. There's really no reason to change their stance immediately, right? So who are we seeing? Morgan Stanley? There's RBC Capital Markets, LSE, and several other institutions' strategic outlooks. Their forecasts aren't just about the next few days or until the end of this year anymore. They're actually talking about next year, even 2026, predicting that the market could rise by more than 10%. So we'll have to see what the final trading day's number is, and then project from that day forward to estimate how much it might go up. That's basically what their predictions are about. That's the range they're optimistic about, right? Okay, and then Bloomberg did an informal survey that also showed that as confidence in the economic outlook grows, it's pushing the S&P 500 to new highs again and again. Global asset management firms are still predicting that this rally will continue. That's not easy to achieve, because if we look at the past 4 years, from 2022, 2023, 2024, 2025, and 2026, let's assume 2026 hasn't happened yet, right? It really hasn't happened yet. 2022 was considered a relatively weak year. But after that, 2023, 2024, and 2025, as everyone knows. All right, those years have all seen pretty strong gains. So people are saying that this 3-year rally will continue into 2026. Let's take a look and see if what they're saying makes sense. On the other hand, Schneider from Gaussian said that tech stocks will still be the key driving force behind overall profits in 2026. That's right, most of the market thinks so too. Otherwise, people really can't imagine what other new or additional forces could support the stock market's rise. Oh, could it be paper companies? Or maybe railroad companies? Actually, no. It's not that these two industries are bad, but if we're talking about driving a significant rally and sparking the market's imagination, that's a different story. So, are these two industries really up to the task? Not necessarily, because railroad companies have their own set profit margins. As for their achievements, well, these companies are important for people's daily lives, but that doesn't mean they can't support the stock market. It's just that if we're talking about continuing to drive a major rally, that's another matter. People tend to think that tech stocks or even semiconductors are always the ones with this kind of consistent momentum, but for capital, it's also about attracting investors from all over the world, especially as we all know. Take the US stock market. If we're not investing in our own country's stock market, like Japanese, Taiwanese, or Hong Kong people investing in both their local and US stocks, the Middle East does the same, investing in their own market and the US stock market. People in every country think this way, because everyone knows that whether it's about regulation or the allure of Wall Street, the US stock market is still the one that's more accessible to the general public, and it's a place that investors all over the world really care about. All right, let's take another look at the biggest companies in the S&P 500. NVIDIA, Apple, Microsoft, Google, Amazon, and Meta. It's estimated that by 2026, these companies will account for 46% of the index's profit growth. In other words, their share is already close to half. And that's just slightly lower than their contribution this year. And this year, their performance has already been really impressive. So even if it's just a bit lower, does that mean the growth will only be slightly less than this year? All right, let's take another look. It's estimated that by 2026, the net profits of S&P 500 companies will increase by another 14%. And as for the Magnificent Seven, their increase will be even more significant. While the S&P 500 is expected to grow by 14%, the Magnificent Seven are projected to grow even more, by 18%. All right, it's like you grow a bit more than me, then I'll grow a bit more than you, something like that. In fact, the Magnificent Seven really are a key factor supporting this round of the stock market rally. Okay, let's keep going. Last Friday, the individual performances of some companies were actually components of the S&P 500. So, which companies in there performed well, and which ones were weaker? Let's look at the stronger ones first. Lululemon, for example. They make things like yoga pants, functional apparel, athletic wear, that kind of company. Just last week alone, their stock went up by 9.6%. Alright, as for the weaker ones, we can see that 3D Systems dropped by 14.66%. So it's actually one of the best and worst performers among them. You might want to look through this table to individually find companies you're interested in. You can further search for news about their industries or individual company financial reports. So listing them here is to give everyone a direction, because as we know, some investors, they prefer or hope for the idea that the strong will remain strong. They believe that stocks that are rising will continue to rise, so they tend to look for those that are performing well. On the other hand, some people aren't used to buying into rising stocks. They might be more comfortable buying when prices are falling. So they might look for opportunities among the stocks that have dropped, hoping to spot investment opportunities or see investment value gradually emerging from there. This is just for your reference. All right, let's take a look at the chart for Lululemon. Looking at the past period, over the last few months, its stock price has actually been fluctuating within a range for quite a while, especially in the past 3 or 4 months. So with this kind of stock performance, we need to see whether it can make a strong push upwards next, or if it will pull back a bit and consolidate within this range. Everyone should keep an eye on this, and today should also be a pretty important observation point. After such a strong rally, can it continue this strong performance today? Also, we see the same with 3DISC. In the past, for example, since it started rising in September, from September to mid-November, the increase was already quite astonishing. Of course, in the past month, it has actually just been consolidating. In other words, it's been fluctuating within a range, without any clear direction. Last Friday, after dropping 14.66%, it looks like it's moving closer to the short-term moving averages, like the 50-day line, or other short to mid-term moving averages. As for whether there will be a further rise or fall, we also need to look at today as a very important indicator, because today is the first trading day of the week, and there are still 4 more trading days to come. We'll continue to observe as the market develops. As new information comes out, we'll update everyone with the latest news. Alright, let's take a look at some industry news. Here it mentions that CEOs usually tend to favor less regulation, referring to government and legal regulations. However, not everyone is happy with Trump's executive order to block states from introducing their own AI laws. Alright, we'll pause here for now. It also mentions that in certain areas, like food safety, environmental standards, and data privacy, both state and federal regulations in the US actually apply together. Let's take another look. People might think that CEOs would welcome the executive order on artificial intelligence that Trump signed last week. That order actually prevents individual states from setting their own AI standards, and instead supports a national standard with the least burden. In other words, it means that the federal government or the United States as a whole would be responsible for setting unified AI standards. So, for example, what about key figures like Sam Altman, the CEO of OpenAI, the parent company of ChatGPT, or venture capitalist Mark Andreessen and AI industry leader David Sachs, these heavyweights in the field? They all praise this move as something the US needs to counter China. In other words, by making this kind of regulation less burdensome and reducing obstacles, it allows all these tech companies, those developing technology, and even those with contracts related to the military, to fully exercise their own rights, using their financial resources, material assets, capabilities, and administrative resources. All sorts of efforts are being made to vigorously develop artificial intelligence. That's because the US is unwilling and cannot afford to lose to China in this AI race. It's the same rhetoric they've always used. Now let's look at which companies are releasing their earnings reports this week. On the 17th, there's LEN, the real estate company. On the 18th, there's NU, Micron, and Accenture. Then on the 19th, we have Nike and FedEx. So these are the companies to watch this week. Let's take a look at the possible positives and negatives. This is basically our second topic for today. Also, this week, the non-farm payroll data is about to be released. Previously, the number was around 119,000 people. The market is already expecting the latest release to be around 50,000, or about 50,000. Let's look at this. It's the orange line here. The green line represents ADP, which is a private organization. If we just look at the employment data alone, so why could this be a potential positive factor? Because we know that in 2022, there was what people called aggressive or even drastic interest rate hikes. Why did those drastic hikes happen at the time? Actually, it goes back to 2021 and 2020. Especially in 2021, the Fed had already misjudged and underestimated the inflation situation. Now, it's understandable that they underestimated it because their background is mostly made up of PhDs, scholars, economists, and policymaking experts with doctoral degrees. It seems like they're used to waiting until the data is really solid and certain before making decisions, right? So it wasn't until they saw inflation getting completely out of control, with the annual growth rate hitting 6, 7, even 8%, that they finally realized things were really out of hand. Only then did they resort to aggressive interest rate hikes. So in this situation now, could it be that they're also underestimating the cooling of the job market? That's a question mark. Not necessarily, but it's a possibility. Let's say they learned from their previous experience. Then this time, if they take a risk management approach to rate cuts, it's very likely that as they see employment data coming in, whether it matches expectations or continues to weaken, they might take further risk management style rate cuts. Or if they still haven't learned their lesson, then just like they previously underestimated inflation, they might also underestimate the cooling of the job market, right? If that's the case, in the end, they'll have to cut rates even more aggressively. However aggressive they were with rate hikes before, they might have to be just as aggressive with rate cuts going forward. This is a possible positive factor, and it could happen within the next 6 months to a year. Alright, let's take a look at the current situation. Here, this is the FedWatch tool from the CME group. We can see that, based on the current market estimates, the probability of rates remaining unchanged in January is relatively high, close to 78%. However, this situation can still change daily depending on economic data or statements from officials. Alright, right now it's in the 70% range. If it drops to the 60 or even 50% range, then it would be about 50-50, and things would become uncertain. So, since there's still some time before January, everyone can keep watching. In other words, the potential for a positive scenario is still there. If before then the situation has already shifted to a 50-50 chance, or even if the probability of no change drops below 50% and the chance of a rate cut in January increases, then the stock market could still have room to rise. Alright, but that doesn't necessarily mean it will actually happen. So what about potential negative factors? If the AI bubble bursts or skepticism about it continues to grow, what are the voices we're hearing right now? Alright, here's one example. An investment manager shared this perspective. We need to consider that there is capital shaping the value of the US dollar right now. In other words, when it comes to tech stocks, the so-called Magnificent Seven, or related chip companies, it's mainly the major semiconductor firms that are involved. So the capital that's shaping the US dollar is concentrated in just a few themes. As we just mentioned, it's focused on things like computing power, artificial intelligence, and related companies, or those involved in electricity supply. If any short-term issues arise with these themes, or if the market starts to question whether their valuations are too high and whether they can continue to grow, in other words, if the growth rate slows down even a little, then the capital will pull out all at once. Basically, they're all talking about the same thing. The logic is the same. When there's pressure, people feel the valuations are too high and can't support further upward momentum, so they pull out first. Stock market investors just exit early. That's basically the point being made. Okay, maybe it could happen, but this was the same last Friday. Whenever the market drops, everyone starts talking about an AI bubble, or whether these valuations are too high, or whether some individual company's debts really can't be sustained. That's the general narrative, but if the situation escalates, you have to be careful. If there's a pullback, that pressure will come back again. In addition, there are also neutral factors, which could be either negative or positive. Here, I'm showing the margin short interest as of November 28th, because it's usually updated every 2 weeks. From what I see, it's updated every 2 weeks. But for now, the latest data is shown here. We can see that the sector with the highest short interest is finance, which seems to have about $2.31 billion. Then there's consumer discretionary at $2.27 billion. Actually, it's generally believed that information technology has about $1.62 billion, which really isn't that much either. You can keep an eye on these sectors. Why do we say this could be either a negative or a positive factor? Because as for the negative side, we know that there are these short sellers right now, these shorts betting against these companies. But what's the positive? If these sectors keep going up, then the amount that's being shorted now could end up in the future with a certain proportion. They could become potential buyers, which might push the price even higher. If the stock price keeps rising, these shorts could actually turn into a positive force, because they might need to cover their positions or even decide to cut their losses. They would have to buy back the shares, and that would become another wave of buying momentum. Alright, let's take a look at the pre-market gainers and losers in the US stock market. First, among the gainers, we just saw, kind of coincidentally, Teradyne is up in pre-market trading by a little over 3%. But since this screenshot was taken around 6 or 7 o'clock, please make sure to check the latest updates yourselves. Before the market opens, make sure to check again. This is just for reference. Also, Las Vegas Sands and Freeport-McMoRan, which is a raw materials company, are among the gainers. On the other hand, among the decliners, ServiceNow is down quite a bit, dropping 2.45% in pre-market trading. Alright, so let's look at why the stock is dropping. Reportedly, ServiceNow is about to acquire this company, Amis, for as much as $7 billion. Amis is an Israeli company. It was actually founded by military veterans, and although its headquarters are in San Francisco, its main focus is on identifying security threats across various devices. Its business spans industries like healthcare, finance, and defense. So it's involved in multiple industries. That means, in my opinion, if its stock price drops, it's probably because people think that ServiceNow might be overpaying. Spending $7 billion on this acquisition could be too much. Usually, it's this kind of skepticism that causes the stock to fall in pre-market trading. As for whether the stock will keep falling after the market opens, that's not certain yet, because honestly, a 2% drop can easily reverse at any moment. If it were an 18% drop, that would be harder to recover from. But if it's only around 2 or 3%, a reversal is very possible. Yeah, sometimes it can reverse even before the market opens, or right after the opening, so nothing is set in stone. Alright, that's all for today's You Want a Session. Good night, and I wish all investors smooth and successful trades. Thank you everyone. See you tomorrow. Bye-bye.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.